Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again my favorite technical analyst, Michael Oliver. And I would say, before we say hello to Michael, I want you to go to olivermsa.com, olivermsa.com, to learn more about Michael and his work. Well, thanks for joining me again, Michael.
Oh, great to be back, Jay.
You know, a year ago or so, you started talking about some major tectonic shifts. And one was the T-bonds. Now, that wasn't going to be the first one that saw any kind of a move, but you took a look at the S&P 500 for the stock market, gold and silver, well, the precious metals. You looked at commodities as a whole. I think you looked at the Japanese yen. These were some of the major markets that you were looking at, and most of them have turned out pretty much exactly as you've expected, with the exception of the S&P 500, which we want to get into in a moment or two. But to me, Michael, the one that makes more sense, the one that's most important, the one I'm most concerned about, is the T-bond market. And you started talking about a blow-off phase for T-bonds, and then, as you noted, and when you get a blow-off phase, you usually get a reaction, an opposite move that signals some sort of a major turning point. And I'm remembering when I paid 17.5% for my first mortgage, I'm remembering when we had T-bond rates at 15%, and the world was an awful lot different than it is now. You got actually rewarded for savings. And we've had this sort of downhill run, which really provided a lot of fuel for stocks over a long period of time, but you could make and people did make an awful lot of money in the bond market. Now we're seeing potentially a major reversal. So to me, your call for a blow-off in the T-bond market is one of the most important calls that I think you've ever made, at least since I've been following you. What are your thoughts now? We see the T-bonds falling a little bit today, so going against your trend here, the noticeable blow-off or a noticeable rise in T-bond rates, not in T-bonds itself, and a decline in rates. But where do you see things going now, Michael?
Well, once I watched the T-bond futures, it's 30-year debt, okay? This is to a less extent in the 10 years, for example, but the 30-year clearly has entered a blow-off on the price charts and my long-term momentum charts, meaning that its normal definition of excess, for example, on a price chart, you've got a channel that you can plot going back to 2003 that the thing has lived within. It's an uptrending channel. We blew through the top of that in a tantrum as we crossed through 170 a month or so ago, shot up as high in the mid-ones up to 177 in 11:30 seconds, I think, this week. Now you backed off into the 173. You're still outside the top of the channel, meaning you're still in the blow-off phase. I don't think this pullback ends the blow-off. I think it's just a dip within the blow-off. Blow-offs usually don't last long, a month or two or three maybe, and of this kind, and they mark the end of something. And with my work on momentum structure, long-term, annual, quarterly of the T-bonds, and by assessing the price chart, putting all that together, it tells me once this blow-off is over and they fall back down into that channel, they will collapse. And I think it'll be equivalent to what we'll call a bond crash at that time. I could see yields on the 30-year, which is now still above 2, I believe, drop below 2%. Which is still a nice rate compared to most long-term debt around the world.
Yeah.
But and then go to 4% rapidly.
Wow.
Once the blow-off top is completed, and the first collapse could easily could double rates from less than 2 to about 4% in the first leg of decline. Now, 4% is no big deal, historically, but to change abruptly rates by doubling them over a short period of time, the long end, the end that the government doesn't really control as well, will have earth-shaking effects. What will cause that? I think the causative factor for bond top and higher rates is simply the emergence of the commodity asset class back to the upside. Mm-hmm. Mm-hmm. It's already beating stocks. You can take the Bloomberg Commodity Index or the Reuters Jefferies and then plot them against the S&P on a spread basis and measure it carefully. You'll see they've broken out, meaning they're beating the S&P, and they're beating it in a way that is it argues an emergence of a longer-term trend, not just a couple months of outperformance. If that's the case, and money is being moved by investors, relatively speaking, out of stocks and into commodities, and you look at any commodity right now and look how much up on the year it is. Let's take a commodity sector like XLE, the energy sector. It's up 15% on the year. What's the S&P up? Less than 5? Okay. Just in 6 months, there's been a 10% profit if you were long XLE, short the S&P, even though the S&P went up. Similarly, gold miners are up over 100% compared to S&P up 5. Some people would like that kind of return over a 10-year period. The point being, you can almost throw darts at commodities or sectors of the commodities and their related stocks and find vastly outperforming situations. That, I think that most investors have yet to really realize that the commodity upturn means business. That it's not just oversold rally in an old bear market that's going lower, that it's actually the beginning of a bull market. And once that perception hits, that will probably be about coincidental with the bond market ending its blow-off and collapsing.
Right.
And of course, you can take your guess as to what the S&P will do with that. I think bonds and the S&P will join at the hip again. Instead of being opposite, I think they'll be in sync.
Yeah, well, I suppose then what you're talking about is the potential for some real some inflation if commodities start to rise. But here's the question I have for you, Michael, and I know that you approach the world, you're very knowledgeable about fundamentals for sure, but your work is technical, and you don't allow your perception of fundamentals to get in the way of the technical. So you're confident about this commodity bull market is for real. It's not just a head fake or some sort of a oversold situation, you're saying. And you're confident because of your momentum work, right?
Right, correct. Momentum and, to a lesser extent, price. And that's one of the reasons I think that most people, when they look at a price chart, other than gold, which is quite strong, but let's say if the commodity basket, either with the indexes I mentioned, Bloomberg or the other one, they don't quite see it yet. The price chart doesn't demonstrably state, I'm a bull now. Yeah. But when I run momentum studies of that price action, long-term momentum studies, annual momentum, for example, they clearly state, no, I'm a bull. And that, to me, is the warning. Usually momentum will move first, and then some months later or weeks later, price will engage and follow its own momentum shadow, as it were. And that's when the public and investors and analysts will suddenly say, oh, my God, we've really got inflation. And you can imagine what that will do to long-term debt yields.
Right, and then, but the thinking now, of course, on the part of most people is, well, the Fed can certainly handle that. The Fed can certainly knock commodity prices down, but I guess in order to do that, they might have to raise rates really high. Or, there's this notion that there's still this notion of the omniscient Fed that can do anything at once, the omnipotent and omniscient Fed that can do anything at once. And, of course, the propaganda has a lot of people believing that they saved the day in 2008, 2009, and therefore we should just put our faith in the Fed. But it seems to me that what you're saying, your momentum work is saying, and price and momentum, and you look at structures as well, of course, and that's saying, no, the Fed, there's going to be a point when they cannot control this thing. They cannot keep interest rates subdued and down. They cannot control the commodity markets, right?
Right. I think we're already there, actually. I just think that the public perception of that is not pervasive enough yet. I think there's some smart folks out there, for fundamental and technical, who realize the Fed really is, the gun's empty, and it's all bluff now, and that they can't manipulation. They were exhausted, and I argue if they do a QE again and create more liquidity, once the performance trend is changed in a way that the average investor realizes that commodities beat stocks, if they QE, that money's going into commodities.
Yeah.
That liquidity will not go to stocks like it did in 2011 and 12 and 13. That was investors' choice. The Fed, the central banks create rivers of money, but they don't necessarily direct where those flows go. The investor ultimately has that choice. And as I read the spread changes, that is actually telling me that smart investors are already making the shift out of stocks and into commodities, and they've been vastly rewarded for 6 months now. Like I said, the percentages are enormous. The gains of commodity-related stocks versus the S&P. And remember, the S&P is a distorted index too, and the NASDAQ 100 is not up on the year.
Yeah.
Okay, that's a blue chip index.
And most of the equity markets around the world are not doing that well, right? Or down.
That's right. The S&P is really I think some of the argument that people are now realizing is that, well, there's so many things that are shaken up around the world, particularly in Europe. There's a lot of uncertainty. Therefore, a lot of foreign money's plowing itself into the U.S. stock market. and it's willy-nilly. Well, when you get that kind of buying that's chasing buying, hold your nose type of buying, that's at the tail end of something. That's not the beginning of something.
Yeah, very interesting point. Well, certainly, the S&P 500 was one of those major tectonic moves that hasn't really cooperated, at least in a timely fashion, with your views. Would you care to comment? What went wrong, and do you think you might be wrong? Is it possible that somehow the S&P could really, you could be completely wrong, and we're going on to a new bull market in the S&P?
I can't buy that. I'd call it a 10% chance, okay? A very slim chance. It better damn well do really well this month. It better get up close to 2,200 at the end of the month, trade as high as 22.25. It better not come up here and make a new high like it just did, and then fiddle around for a week or two and waste the month. Because there's also time factors involved in a lot of these momentum studies, and I think the clock is ticking. They've got to go through the goalposts, and if they don't get through the numbers that I've specified, I think this is a tease, it's a false price breakout, and it will fail. Fortunately, to our subscribers, at the February lows, we put out a report warning after the 230-point drop in January, February, which we did call, that if you were short, you better hedge up, because there could be a rally that could take away your profits. We prefer, and we're not money managers nor investment advisors, we analyze markets, that I think spread positions are where to be, meaning long assets and short assets even, like short S&P 50%, long energy stocks, long basic material stocks, long gold stocks, such that you really have a market, quote, neutral position where you're long the good stuff and short the stuff that's less good or outright weak. And that position you can sleep with at night. It's not a net short.
That's a good strategy. We do like to sleep well at night, that's for sure. Well, Michael, with about 2 minutes left here, I'd like your comment on gold. You've already commented on it, but I see gold and silver is really outperforming gold now. Gold isn't doing badly. I think today it's down a bit, but silver has been creeping up on a day when gold is down a little bit. Silver is creeping up. This is what you've expected, though, I believe, in a bull market, a precious metals bull market, is once it really got underway, silver would outperform gold, right?
And it is doing so, and it's done it with a thunderbolt like a week or two ago, where silver basically popped $2, while gold went up a bit. But I mean, the percent gain for silver was enormous. Well, when you do a long-term spread study of silver relationship to gold, you'll see that was a breakout, and clearly silver is now the better place to be if you want to own the metal itself than gold. Gold miners, of course, are as we expected, are handily beating both, and I think we'll continue to do that for foreseeable future.
Well, there's some nice silver mining stocks, too, though, that might actually beat some gold mining stocks. I mean, there's not that many of them, but we do follow a few of them in Jay Taylor's Gold, Energy, and Tech Stocks, so I put in a shameless plug for my newsletter. Michael, anything else, and anything else you'd like to comment on today?
One other thing, the euro. We had the drop after the Brexit. The BP got whacked the most. The euro got whacked pretty good, but if you'll look carefully at the euro, it only fell halfway back into a one-year range that it's been stuck in. It fell down to around 110, 111 area. If that currency, I'm looking at euro futures, gets back up around 112 again, it's only up 1 cent above where it is now, next week, if it gets there, I've got some near-term stuff that says it's breaking out upside, and if that breakout is sufficient to get the euro futures back above 114.5, especially closer to 115 on a weekly closing basis, it's going to break out upside and have a large move, much like the yen has had over the last 6 months. The yen went from 80 all the way up to 101. I'm talking futures now. 83 to 101 as a huge move for the yen. But the problem is the yen is only about 17% of the dollar index.
Right.
The euro is 57% of the dollar index. If you're concerned about the dollar, watch the euro. Because if that thing turns a penny or two, I think it could run a 3 or 4, and if it runs 3 or 4, it's going to run 10 or 15. And that would be an enormous whack for the dollar index.
For the dollar index,
I think was what your prior guest was talking about.
Yeah, indeed. Well, thank you very much, Michael. So we'll keep our eye on 114.5 to 115 for the euro, I guess, right? And
correct. That's a major level.
Very, very interesting. All right. Well, always good stuff. Thank you so much, Michael, for being with us, and we'll look to do it again next week if possible.
Thank you, Jay.